Good afternoon, good morning, or good evening, everyone. Today I'm going to be discussing the tax implications of business structures, sole proprietorships versus LLCs, S corps, and C corps. And today I will discuss all these. Uh, I'm Amir Mian. I'm a fellow student here at Fairfield University, and welcome to Introduction to Accounting presentation. Today I'll be presenting an overview of the common business structures, including sole proprietorships, limited liability companies, S corporations, C corporations. These business structures each carry unique legal and tax implications, and understanding them thoroughly is key for anyone involved in business law or accounting. In this presentation, I'll be walking through the defining features of each structure, their pros and cons, why choosing the right one is such a critical decision for entrepreneurs and professionals alike from a tax perspective. When starting or growing a business, one of the first major decisions is how do you choose the right legal structure? Should you, for tax accounting purposes, this affects how business is taxed, how profits are distributed, and how much personal liability the owners carry. It also plays a big role in how the business is managed from it and how it grows over time. In this presentation, I'll be focusing on four of the four most common business structures: S corporations, C corporations, LLCs, and sole proprietorships. Why should we know about tax implications in business structures? Why do we have to know this? Well, as business students and future entrepreneurs, understanding how tax impacts each structure helps us make smarter startup decisions. Each of these business structures has its own advantages, limitations, and accounting rules. Understanding these simple differences between them is important, not just for accounting purposes, but for making prudent business decisions. The goal of this presentation is to present a clear, straightforward breakdown of how each structure works and why the choice of business structure matters in real-world situations. Entity choice matters because it affects taxation, income, self-employment, dividends, ownership rules, reporting requirements, long-term growth strategy, and also chooses how much of your personal assets are at risk. It's crucial for entrepreneurs for liability and asset protection. It's important for accountants and lawyers to learn so they can provide competent tax accounting advice to clients. So, sole proprietorships, partnerships, S corporations, C corporations. A sole proprietorship has business income reported on the owner's tax returns. Partnership has business income passed through partner tax returns. S corporations has business income passed through the owner shareholders tax returns. And C corporations is subject to corporate income tax. So the easiest one is sole proprietorship. It's very simple to form. You don't need to file separate taxes for your businesses, report business income and losses on your personal income tax return. However, a sole proprietor is personally liable for legal judgments, taxes, and debts. Quarterly tax payments are based on estimates for the year must be made. You will receive a refund if there's an overpayment of taxes, or might have to pay more taxes if they are underpaid. Self-employment taxes are required because they are no payroll taxes. Filing sole proprietor taxes involves reporting business income on Form 1040 using Schedule C profit or losses. You file a Schedule C to report self-employment taxes, and you're taxed for the full profits of your business, even if you have not personally withdrawn the money. You fill out Schedule C, detailing your profits or losses in a Schedule SC, which you submit alongside your Form 1040 income tax return to the IRS. You can take business deductions such as operating expenses, advertising expenses, business-related travel, and entertainment expenses. Sole proprietorships, to take advantage of deductions, a sole proprietor would need to keep meticulous records. They keep separate accounts for your personal and business taxes. Keeping records separate will help maintain clear and business-only tax returns. It will also demonstrate to the IRS that you're a sole proprietor, try to separate their business expenditures from their personal ones. Paying self-employment taxes. Sole proprietors pay self-employment taxes covering Social Security and Medicare. Tax rates differs from employee payroll taxes. Must make quarterly estimated payments on EFTPS, which is how businesses pay it. EFTPS is a government website where a business can easily make quarterly payments. It stands for the Electronic Federal Tax Payment System. You can set up quarterly payments to the government. It applies to single-member LLCs as well. Sole proprietors pay full FICA while employees split it with their employers and can deduct 50% of self-employment tax to reduce taxable income. Businesses operate as sole proprietorships or general partnership. That's if they don't incorporate. Both entities do not provide many benefits. Incorporating could help to develop the following benefits: liability protection of personal assets, expenses that become deductible in a tax return, flexibility in taxation, perpetual existence makes the business more credible, and separate legal entity from an individual person. For example, Microsoft is not a sole proprietorship. They're not a partnership. They're not an LLC. They're a corporation. That's what makes them more prestigious, more credible. And they also have more flexibility in taxation, perpetual existence, and liability protection of personal assets. So here's an example of a sole proprietorship. Peter owns Malagutis Landscape. He reports profits and losses on Schedule C with his Form 1040. He also files Schedule SE for self-employment taxes, Social Security, and Medicare. Joe Devlin runs a taco truck. If he deducts mileage, food supplies, and advertising, he also uses Schedule C and Schedule SE. An LLC is a business structure allowed by a state statute. A limited liability company is a non-incorporated business entity combining elements of partnerships and corporations. The owners of an LLC are called members. Members can include individuals, corporations, other LLCs, and foreign entities. No maximum number of members in most states permit single-member LLCs. So here's an example of a partnership. Bill and Hank run H&B Bars. The business files Form 1065 U.S. Return of Partnership Income. Each partner receives a Schedule K-1. Users should report their share of income on Form 1040. Tony Copani, for example, and his friend operate Copani Photo Company. They will split income 50-50 or also report via K-1 forms. Single member LLC. Income tax is treated in the same manner as sole proprietorship. The income and losses of the business flows through the owner's personal income tax return. S corporations pass through taxation entities that don't pay income taxes at the company level. S corporations file an informational Form 1120-F. Profit or loss is passed through to the owners. Owners report the income on their personal tax return. Any taxes owed are paid by the owners, not the business. To become an S corporation, a company must meet strict requirements with the IRS to qualify for S corporation status. An S corporation must be owned by shareholders and run by a board of directors. An S corporation is run by a board of directors. It must hold an annual shareholders meeting and directors meeting, document any key shareholder decisions, and file separate corporate income tax returns. IRS grants S corporations a special tax status, allows corporations to pay their income, pass their income through the shareholders instead of getting taxed at the company level. An S corporation shareholder who performs substantial work for the company is considered to be an employee, is required to take a reasonable payroll salary. So if a company makes $1 million, the S corporation shareholder cannot make $20,000. It must be reasonable. If an S corporation owner pays themselves a suspiciously low salary, they can run into trouble with the IRS if they take most of their compensation in the form of distributions. The IRS can revoke an S corporation status if they investigate and determine that shareholders are substantially underpaid for the services they provide. S corporation tax advantages. It lowers the self-employment tax burden on LLC members. The only tax that is subject to self-employment tax is paid to an LLC members on payroll. LLC members may find that S corporation election lowers personal tax burden because profits are paid as distributions, are not subject to Social Security and Medicare taxes. Some of the disadvantages of S corporations are they may limit growth potential. S corporations are limited to no more than 100 shareholders. The ability to expand may be limited. To maintain compliance, an S corporation must understand and adhere to the requirements of reasonable compensation. At the state level, S corporations are not treated equally at the state level. Let's give an example. Constance owns Rudnick Consulting as an S corporation. The business files Form 1120 U.S. income tax return for an S corporation. Rudnick receives a Schedule K-1 for his share of profits, reports on Form 1040, and gets a salary report on W-2. Another example. Lawrence and Obed converted their cleaning business to an S corporation to save on self-employment tax. They both received K-1s and paid themselves via payroll. C corporation. C corporations are their own taxable entities. They pay taxes separate from their owners. C corporations file a corporate tax return using Form 1120. C corps also face the possibility of double taxation if corporate income is distributed to business owners as dividends, which are considered personal taxable income. The company pays taxes on its income first. If the business pays out dividends to owners, those get taxed again on the business owner's personal tax returns. C corps can get hit with double taxations, once at the business and level and once again at the individual level of dividends. Tax advantages of C corporations. Corporate income tax returns may be favorable if a corporation's profits get taxed at the corporate income tax rate 21%. In certain situations, this might benefit a business owner. Depending on the location and shareholder's personal tax situation, a business owner might find that the corporate tax rate will cost them less if they were to establish an LLC. There's a possibility of more taxable tax deduction opportunities. For example, as a C corporation, the business may be eligible for more tax deductions than they would be established, and if we establish it as an LLC, partnership, or proprietorship. Eligible C corporations can choose to be taxed as an S corporation, which enables them to avoid being double taxed. Nobody likes to be double taxed. Salt deduction. The state and local tax salt deduction allows taxpayers who itemize in their federal tax return to deduct up to 100% of combined property taxes in either state income or sales tax paid to state and local governments. This deduction is intended to offset some federal taxpayer liability by excluding income already taken in taxes for state and local government services. It disproportionately benefits high-income taxpayers. C corporations are owned by shareholders and run by an elected board of directors. For small businesses, they are not ideal unless the company is going public or seeking venture capital funding. They must hold annual shareholders meetings and directors meetings, maintain key shareholder decisions, and file separate corporate income tax returns. Here's an example. Copani owns a growing pizza chain under C Corporation. The business files Form 1120 U.S. corporate income tax return and pays corporate income tax. Tony gets a W-2 salary, and if a business pays dividends, he reports them on Schedule B in his Form 1040. Here's another example. Bill forms a C corporation for his tech startup to attract investors and issues stock options. The corporation is taxed separately. Conclusion. Choosing the right structure can minimize taxes and maximize growth. Accurate tax planning is important for the growth and structure of a business. Understanding these structures can help you make smarter decisions now and in your career. Parting message. Pay yourself before you pay others. And the right business structures will ensure you keep what you earn. Thank you for your time.